While significant progress has been made to strengthen the financial system, I believe the act did not go far enough. I believe the biggest banks are still too big to fail and continue to pose an ongoing large risk to our economy. Failures of large financial institutions pose massively asymmetric risks to society that policymakers must consider. We had a choice in 2008. Spend taxpayer money to stabilize large banks, or don't, and potentially trigger many trillions of additional costs to society. A very crude analogy is that of a nuclear reactor. The cost to society of letting a reactor melt down is astronomical. Given that cost, governments will do whatever they can to stabilize the reactor before they lose control. I believe we need to complete the important work that my colleagues are doing so that at a minimum, we are as prepared as we can be to deal with an individual large bank failure. But given the enormous cost that would be associated with another financial crisis and the lack of certainty about whether these new tools would be effective in dealing with one, I believe we must seriously consider bolder, transformational options. Breaking up the large banks into smaller, less connected, less important entities, turning large banks into public utilities by forcing them to hold so much capital they virtually can't fail, with regulation akin to that of a nuclear power plant, taxing leverage throughout the financial system to reduce systemic risks wherever they lie. The financial sector has lobbied hard to preserve its current structure and thrown up endless objections to fundamental change. And in the immediate aftermath of the financial crisis, when the Dodd-Frank Act was first passed, the economic outlook was perhaps too uncertain to take truly bold action. But the economy is stronger now, and the time has come to move past parochial interests and solve this problem. The risks of not doing so are simply too great.